Today we'll be looking at the Marshalls Group. Thank you for joining me as always. Now, I did just look at Ibstock, which is one of their main competitors, and roughly of the same market cap in the 600 million range, we have Marshalls. Now, they provide paving and walling systems, street furniture, drainage solutions, bricks, and many more things. Bollards, roof tiles, quite a wide range. They claim themselves as the UK's leading hard landscaping, building and roofing product supplier, providing to not only commercial but to consumer and builders. Now, they have quite a long history dating all the way back to 1890, where they were founded by Solomon Marshall in the heart of a Yorkshire town. Nice. Okay, so let's go on to Simply Wall Street and have we look at their stock. Now, they are down 60% over the last year, trading at about £7.13. They're now currently at £2.83, which obviously is a pretty steep decline, and we'll look into as to why that might have been the case. We can see here that their ticker symbol is MSLH, and their snowflake isn't looking as healthy as Ibstock, but there's a few merits that I must point out. 3 out of 6 on their dividend. They have a respectable yield of over 5%. They also have 3 out of 6 on their financial health and 3 out of 6 on their future growth. We can see here it's a mediocre balance sheet with moderate growth potential. Currently trading 37.7% below its fair value on a DCF model. Earnings are forecast to grow 18% over the next few years. Their dividend is not well covered though. They have a volatile share price over the last 3 months. They had a large one-off item on one of their most recent financial results, and shareholders have been diluted in the last year. Right. Now, Ibstock, as you can see, one of the top competitors there, similar market cap, of course. And obviously with the housing market the way it is, being very volatile, in the run-up, especially into August, September, October, there, a lot of the house builders as well as suppliers such as Marshall and Ibstock took a massive hit. So the year overall hasn't been going very well for Marshall at all. However, maybe their luck is about to change. We'll look at future growth and see how they stand on that one. They have 2,700 employees, and currently their CEO is Martin Coffey. We can see their pay ratio is 17.1 times. Earnings sits at 41,060,000 and revenue at 639.51 million. Market cap obviously just slightly below their revenue. When it comes down to their earnings, their last reported date was June 30th, 2022, and the next date that you'll need to keep an eye out on is March 17th, 2023. They have a gross profit margin of 61.21%. It's very modest. And a net profit margin that was 6.5%, quite below their competitor Ibstock. Their payout ratio sits at 77% and a yield of 5.4. Moving on to their valuation, we can see, again, we already looked at their pay ratio. How does that compare to competitors? Well, it puts them, in terms of their peers, such as Ibstock and Breeden Group, they are somewhat at the higher end at 17.1, Ibstock sitting closer to 10. Now, industry average again 9.9, and they sit at 17.1. So food for thought on that one. When it comes down to a look on their future cash flows, we can use a DCF model and see that they're currently at 37.7% undervalued. Now, that would mean that a fair value would be £4.54. They have, of course, been at that level not too many months ago. In fact, they were closer to £7, which on this model probably would have been seen as actually overvalued. So again, another model to work off. Down to future growth is where things get interesting for them. They are forecasted to almost double their income in the next few years. So currently sitting at 640 million, 41 million in earnings. Over the next few years, they're hoping to get to 809 million revenue and 80 million in earnings. Definitely racking up the earnings and the free cash flow as well. Of course, these are forecasts, so bear that in mind. Down to their past performance, things were looking very well for Marshalls. The market, obviously, in housing was booming. Things were looking good up to 2020. The pandemic hits profit margin and revenue is hit quite hard. They have somewhat recovered, but definitely not recovered to their 10% profit margins that they had pre-COVID. So that's something to obviously keep in mind, as well as operating expenses have increased over the past few years. And with the recession and just the general inflation, it's definitely impacting them for sure. Down to their financial health, we can see that they have a score of 3 out of 6. We'll see why that's the case. Short term, 380.53 million. Now that covers their short-term liabilities, but it doesn't cover their long-term, which is why they didn't score well in the long-term liabilities. But doesn't tell the whole story. They do have a 40.6% debt equity ratio. Debt sits at 286 million. Cash and equivalents at 79. Equity 705 million. We can see here they haven't been reducing their debt, and there was a spike there over the last year. But their debt is covered by operating cash flow, although not well at 11.6%. Their interest payments, however, are covered at a 15.5x, which is seen as well covered. We can take a wee look at their balance sheet here. We'll also be looking at the balance sheet and alpha spread, giving a different graphical perspective on it all. Down to their dividend, everyone's waiting for this. 5.41%. Puts them well above the industry average, just below the market top 25%. It's actually forecast to grow in the next 3 years, as opposed to Ibstock, who wasn't forecasted to grow in the next couple of years. We can see they were paying a modest dividend and yield all the way up to the pandemic, where they actually achieved 1.7% yield. Now, they did restart payments back in 2021, and they have surpassed pre-COVID levels to level out at about 5.4% at their current market value. Down here, we can see the earnings payout. It's well covered, but the cash payout, not so much. That is definitely a cause for concern for me on their dividends. It may be cut due to, this if they don't fix it. Management, 2.7 year average tenure, which isn't the most I've seen, but their CEO, Martin Coffey, has been in the business for 9.5 years, which makes it, means he's pretty experienced when it comes to this industry, certainly. He oversaw the company earnings booming up until COVID. Of course, every CEO had to deal with that. And for the ones that stayed, he's at least got them back to pre-COVID levels in terms of company earnings. When it comes down to their leadership team, again, average tenure 2.7 years. Not the most experienced, but it is considered experienced if it's over 2 years. So that's something to bear in mind. Whilst I can say that their board members at 5.2 years average tenure is a lot more experienced. Now, when it comes to insider ban, there's been dashes of shares bought here and there, but nothing above 86,000, so it wouldn't be considered major. Now, their breakdown is quite interesting. 84.8% institutions. VCPE firms make up 8.8%, and then the general public and the employee share scheme in 3rd and 4th place. Now, they have had their total shares outstanding grow by 26.8%. Now, the dilution has probably been a major reason as to why their share price has almost collapsed over the past while, or it's definitely been a factor in that. Now, Aberdeen PLC are the top ownership at 11.5%. Inflexion Private Equity Partners, that must be the VCPE firm. The private equity firm that sits at 8.75%. And Montanaro Investment Managers are in 3rd. Vanguard and BlackRock are way down there at 6th and 7th place. Rare to see that. Okay. How many employees? 2,700 employees. Right. Over to Google now, if you wanted to have a wee look, a free search up on Marshalls. Google's a fantastic resource, definitely in the same lines as Simply Wall Street. Simply put in either Marshalls PLC stock price or LON-MSLN and it'll bring you up the screen. Gives you, a lovely chart to look at their share price. You can look out the past 5 years and see how they've been performing. Gives you all their fundamentals, market cap, pay, dividend yield, highs and lows of the past 52 weeks, and all the information you may need in the company, as well as news. We can also compare them to competitors and check out their financials. Moving on, we can go onto Alpha Spread and see their intrinsic value, another model that I use to look at firms. We can see here it's a discounted cash flow model against a relative value model. Now, at the moment, that gives them a 75% undervaluation with using this intrinsic value model. Their price, £11.05, is obviously a whole lot higher than their current trading price at £2.73. Over on Alpha Spread, you can also get a lot of information on their financials, balance sheet compositions, and you can see efficiencies alongside capital structure and Wall Street target prices. Really good website, highly recommend it. There's a link in the description if you want to have a wee nosy at it. Right. Dividend Max, another website that I use. This one is specifically catered to the dividends. Gives you a brief dividend summary, when it's expected to go X, when it's going to be paid. You can see how often per year they pay them. Typically it's 2 dividends per year, so they pay every 6 months. And we can see here the status of the previous dividend and the next one. There's an interim and a final, meaning that one is probably more expensive than the other. Always expect the final payment to be more expensive than the interim one. That usually is a good rule of thumb. You can see a final here of 9.6 pence. The interim is 5.7, which is an increase of the last interim, which was 4.7. Good to see. You can put in as many shares as you want. You can also sign up for the website and it can give you the next payment. And that is based on a forecasted amount. It'll be declared on the 9th of March, and then you'd need to own the share by the 7th of June. Not the 8th, the 7th, always a day before the ex-dividend date. If you want to get the payment, always remember that. My final thoughts on the Marshall Group is that whilst they are currently trading at a very enticing price, there is a lot of headwinds coming on the horizon, such as the continuing recession, inflation, increased prices of all their items, and the housing market. And with all that in mind, they will be put on my watch list and I will keep an eye on them. Be sure to let me know what you think in the comments section below. Do you believe that Marshall is worth a buy, a hold, a sell? And be sure to check out my next video on Ibstock, or one of the many suggestions. Thank you, and I'll see you all in the next one.